Hello and welcome to the Mutual Fund Show. I'm Neeraj Chawla. The next 20 minutes, we'll talk about 2 or 3 key aspects of mutual funds this time around, based on our research and a bit of feedback that we got from viewers and readers, I might add. We're choosing to talk on 3 things. One, criteria. Amongst the criteria for selecting your mutual funds, most people say that past performance should not be, is a necessary condition, not a sufficient one. My question to our guest today is, should past performance be completely ignored, or is there merit in even giving some bit of importance to past performance? That's part one. Should IT sector funds be looked at currently, because that space is in the eye of the storm after a couple of large firms came out with news flow supposedly that they're holding back some variable pays? So our company is going to be under pressure, or is this actually the time to take exposure to those funds? Maybe our guest can answer that too. And lastly, a lot of conversation around whether the new age funds that have come in are giving the erstwhile funds in some pockets a run for their money, and should you look at some specific offerings of some of these new age fund houses as well? So we'll do all of that with our 2 experts today. Kshitiz Mahajan, he's been on the show a number of times, needs no introduction from Complete Circle. And our Lovaii Navlakhi also needs no introduction, but is joining us for the first time on the Mutual Fund Show. Gentlemen, both of you, thanks so much for joining in.
Thanks for having us here.
Now, the pleasure is ours. Kshitiz, can I start with you? Most people say, and in fact, I've heard a lot of people say that, past performance should be ignored because a fund having done well in the previous year will not do well necessarily in the next year. And most people tend to look at the past performance while choosing a fund, which is maybe wrong. But my question is ignoring the past performance completely also a wrong thing to do?
So, Neeraj, I think this is the most relevant thing which normally pops up when you look for fund performance. All the websites across various third-party platforms, they normally talk about past performance as the criteria. But having said that, I'm not saying it's wrong, but it can't be the only criteria. People which are looking at it, they are from their side, they are right at looking at how the fund has done over a period of time. But that can be one of the criteria. It can't be seen as only one thing while selecting a fund, because eventually you will like to see that in strategy in which you are putting in money, irrespective of whatever they are doing, but are they generating return or not? So that is also important. So I'm saying, but yes, the only criteria to look at only returns can actually backfire big time, because normally when you see mutual fund ads also coming, past performance may be sustained or may not be. That's not in our hand. But at the same time, it gives you an idea about how the fund's been doing over a period of time. Moreover, in past performance also, many people, they go level 2. They look at rolling returns, or let's say how the drawdowns have been when markets have been falling. Obviously, if you are in line with your index, or let's say a little better with your index, that gives you a little comfort that yes, this without taking less of risk, it has been able to generate a better return. So past performance in conjunction with your benchmark, as well as there are 3-4 various parameters which one should look at while looking for a fund or while shortlisting a fund. It can be a fund house strategy, investment philosophy, consistency of a fund manager with the fund. So that also plays a very important role in our industry, especially on the manufacturing side. The most important point here is, sales and everything goes to the second level, is the fund management. Because if you have a fund which is running by a same guy with the same consistent philosophy for, let's say, 7, 8, 9, 10 years, or let's say 4, 5, 6, 7 years, then you are a little confident with that fund house, or let's say fund manager. Yeah, you understand his style and you understand how he's doing things. So that's one of the main criteria. Then investment philosophy. If you are a value investor, then doesn't make sense for you to go for a growth strategy. Then you will like to go for a value fund, or let's say a growth fund, rather than just looking at, irrespective of my strategy is this, but because the performance is like this, let me go for this. But yes.
No, agreed.
Yeah.
No, completely understandable. No. Okay, let me try and rephrase my question, Mr. Navlakhi. Let me get into the conversation. How do you use past performance when as a tool for making future decisions?
Yeah, I think that as you mentioned, unfortunately, the information to an investor that is available, is limited to return. You do not really get the more sort of deeper insight that we as, investment advisors might have access to. or are willing to spend time and invest on. So one of the things I definitely think is important is the rolling returns rather than point to point. And I think even before you get to that, unfortunately, the past returns of the last 1 year, last 3 months, 6 months become paramount in decision making by individual investors. The question I have to ask them is, what is the time period for which you are investing in that particular category? If you are investing with a 3, 5 year outlook, then don't look at 1 month, 3 month, 6 month returns because that's not the right comparison in the first place. I think the other thing you have to recognize is that fund management styles of performance is cyclical in nature. So that different points in time, there'll be certain schemes which will underperform, certain schemes will outperform. And it's very difficult to determine how long that cycle is. Uh, so it's important to also then look at some risk factors because investing is not all about return. It's also about protecting risk. And one of the ways you might look at is what's the standard deviation. So how volatile is that fund? As Kshitiz again mentioned, what has been the type of drawdowns. And in the example I can think of is, if you have a fund which ends up giving you 9.5% in last 1 year and last 2 years, both years it has given you 9.5%. And there's another fund which has given you 27% or 23% in 1 year, but a minus 4.5% in 1 year. The average will end up being the same. But obviously, the fund which gave you plus 23 and a minus 4 is a lot more volatile. Now, again, that doesn't mean that volatility is bad. It depends on your risk profile. You like to ride and enjoy, the ups and downs and go on a roller coaster, then good luck to you. I don't like the roller coaster, so I tend to go to a little more safer and state sort of places. And that's, I think, your dependency. Plus many other things like the fund house stability, performance. What are they saying when they don't get it right?
Sure.
Because I think each investor, each fund manager makes mistakes. What do they learn from that is becomes very, very crucial and important.
Okay. So Kshitiz, sorry, just before we wrap this topic, how do you use past returns? I know you said that people shouldn't look at past returns. I get that point. But how do you make use of past returns in a nutshell?
So, Neeraj, interestingly, if you actually want to make the best use of how past performance has been, look at SIP returns. Because it's a monthly input, step which you do, and how the SIPs have performed over, let's say, last 3, 4, 5 years. I agree with sir, and I want to quote here. Let's say 2017, if you recall, Neeraj, mid cap index fund was 48% up. Funds I'm not talking about, and small cap was 57% up. And 2018, the new regulation and long-term capital gain, and then the new regulation by SEBI about small cap, mid cap, and large cap investing. The return for that year was so down that all the mid cap and small cap were taken between more than 40-50% that calendar year. Now, many of the clients who were going through various portals and investing into for the first time they're coming in, they were just participating in mid and small cap only, without judging for the risk part. So I think the best part is that 1 year which has done so well will make you look last 5 years return very good. But the rolling return is the right way of looking at it, how the funds are done over a period of year. This is something one. Second is the SIP way which we look at, how the SIPs have done over a period of time, because it's a monthly input part. So these are the two criteria which we look at. At the same time, we look at the beta part and standard deviation part, which sir also mentioned, I also mentioned about the drawdowns, because that gives me little comfort that without taking maybe taking little less of risk as well as index, I'm able to generate or beat my benchmark.
Okay, most of this is well-known, viewers, but I thought it was important to kind of ask the counter question as well. And I think we got some interesting answers thereof. Let's move on and talk about IT sector funds. Typically, thematic funds, viewers, I remember for people who can take a bit of risk, maybe ideally can do a bit of study as well. But still, let me pose the difficult question to my experts. Mr. Navlakhi, I'll start this one with you. IT sectoral funds, do you have a view on them?
Yeah, the first view is that, you really need to avoid sectoral funds if you can. And for the lay investor, I think the simple reason for that is that if a particular sector is really doing well, in your diversified equity funds, it will automatically gather a higher weightage. So you will get the benefit of a higher return from a particular sector when it is doing well. That's number one. Number two, as we well know, that the cycles for the returns for these sort of sectoral funds is a bit sharp in the sense of the return that you might make as well as the negatives that you might face. And therefore, when we think of investing and we think of equity investing for the long term, the sectoral funds actually don't fit the bill in that way, unless you're really willing to fill it, shut it, forget it. Most people, because NAVs are visible, uh, it's difficult to ignore. Then you're trying to look at and say, oh, should I exit this fund? And then if you get your timing wrong, you're caught at the wrong end of the cycle. So
True.
IT as a sector, yes, we do like. It's a good idea to have exposure, etc. But I think when the going is good, the diversified equity funds will have that higher exposure and you will get benefit from that. So I am not so sure for the lay investor. For the more advanced investor, yes, but then be ready for in and out a little more uh, frequently and the impact therefore on capital gains, etc. You're willing to take that, then it's worthwhile looking at sectoral funds.
Okay. Kshitiz, purely from a perspective of also somebody who runs a bottom-up portfolio strategy, are IT sectoral funds from a timing perspective are good ones to get into currently? The risks for a thematic fund, etc., all have been well described by Mr. Navlakhi. So I'm trying to ask further this conversation with you.
So I'll just compare ourselves with various emerging economies where IT participation in the broader index, not talking about NASDAQ, but broader index is 30-31%. We're at 19-20% of late. And many of the funds, none of the fund is in line with in their strategy around 18-19% also. Most of the funds are 13-14-15% in a flexi cap or let's say multi-cap or large cap funds. Now, I'm coming from a different view that funds, or let's say any strategy, which is not only having technology stocks, but those businesses also, which are having technology as catalyst. Output can be anything. It can be a food tech, insure tech, fintech, anything. I think those type of portfolios should be looked at rather than just looking at, and I'm with Navlakhi that rather than just looking at technology stocks, those businesses which are using technology as the catalyst to move to the next level, or which are actually integrating their back end and front end through technology, can be looked at. Look, we are in digital India phase, and this decade is total a tech-driven decade for sure. And now maybe 2030 onwards, there is some new concept will come in, but this decade belongs to technology. I think there are a lot of businesses, irrespective of now. I understand that what type of news right now coming, but that throws a lot of opportunities also. There are many portfolios, and I don't want to name it, but there are many strategies which focus on the digital India theme, and where they are imbibing technology at the next level for growth. And I see that those funds or those companies should do very well in coming times. So I have a very strong conviction that this sector is much broader than what we think. It is actually growing horizontally than vertically. More and more, a lot of companies are coming to this space.
Yeah, but Kshitiz, my question is for people who can't afford a 50 lakh rupee PMS but want a mutual fund offering in IT Sing. Are there options out there?
Yeah, there are options out there, and I like a couple of them where I am talking to their fund managers also, and I'm looking at their portfolio also. And once you go to the portfolio, you will also see that change which I'm talking about, being sector growing horizontally. They are also incorporating a lot of those businesses which are not a tech company, but they are offshoot of tech company, where they are now realizing that the next level of growth will come from tech. It can be biotech, it can be short-term revenue company. So yes, I'm talking about it from a retail perspective also. Having said that, this can be categorized into a sectoral allocation and can be more than 5 to 10%. And long term, 5 to 7 years is what a view one can take while participating in these businesses or this type of.
Okay, are you at a liberty to name them, Kshitiz? I'm not gonna push you if you don't want to.
So these are not recommendations. There's something which I like from my side. One is offering from ICC Group, which is a technology fund, and the second is from your Tata Digital Fund. These are the two schemes which I like. Again, there are no recommendations. This is something which I like personally.
Sure.
So Neeraj, just one thing I thought I should add here that when you look at what Kshitiz is describing and then the technology funds tend to concentrate in the same sort of places, which are the known places. They don't necessarily go out to this to these other businesses that Kshitiz was talking about. And what I think I have seen in the technology fund, from what data I did read, is that almost 77% of the holding is in the top 10 stocks. So they will tend to be the, the INFIs, TCSs of the world. So really on, that extra that you're looking for, and that then becomes a stock picker's, I think, ability to say, yeah, this particular fintech or this particular food tech, and maybe it even gets into private equity space, then is really going to outshine the rest in that particular sector. So for the lay investor, then I don't really know whether you're getting that what should I say, that factor in your investment that you're looking for.
Okay. Jamin, thanks for that as well. Sometimes viewers, the more answers you try to get, it might be a bit confusing as well. So try and choose whose conviction, if at all, you thought more. And I think the answers kind of match as well in the sense that if you're a risk-averse investor, maybe getting into a sectoral fund of any sort, forget tech, any sort is not your cup of tea. But if you do believe, if you are a tech industry user, and if you do believe that this is a decade of tech, then sure, there are a couple of examples that Kshitiz likes. You should do your own research, viewers, before you go out and buy it, or consult your financial advisor, of course, if you have one. Last point, and Kshitiz, this one I'll start with you. A lot of fanfare around the new age MFs, and some of them are doing quite good on the performance charts, for example, or in terms of the product offerings that they have. What is your thought onto some of those and the product offerings that they have vis-a-vis not the erstwhile, but the established, if you will, fund houses?
So yeah, again, Neeraj, what I have learned from many of your shows also that there's enough food for everyone, and all these new players, they're coming with a big bang. Look, we are a young tech savvy nation. More than 60 crore of population is under 40. And these all new, low cost offerings which are coming, they are more on the tech side, on AI side, or let's say factor-based fund which are coming to play. They are saying let's cut on the human intervention. So it's obvious, like somebody who's actually into FD or let's say RD accounts, they are looking at participating into equity. Index is a good way of participating into equity. A country where you have a nominal GDP of 12%, you can easily make 11-12% through index fund only. And then they are cutting the cost, because cost is one element which obviously over a period of time can actually pull down or drag the return down. But having said that, on a large scale space, I think that makes sense because of the regulation, you can't move much beyond 80% of the allocation in top 100 stocks. So there are many such new businesses which are coming with a low cost index fund, which are coming on a factor based fund, and I think there is enough scope for them to grow. And many clients which are coming into the industry, they don't want 40-50 stocks to analyze. They also want to focus on a different style of thing. So a couple of AMCs have thought of having their one flagship fund, and they're just focusing on that fund only. Let's say PPFSA or let's say Quant mutual fund. They are very clear that how they want to grow. They have their flagship strategy, value-based thing. Their prediction is there, and they're doing that. And where client is also he's also liking that they are not diverging into so many other funds also. At our end also, whenever we are talking to anyone, we also always say that let's keep it short rather than just diversifying. End of the day, you over diversify by investing into too many schemes. That's also drag your return down. You don't have to be having so many schemes on your side. So one, these low cost offerings which are coming, yes, they are making some gain. They're getting some allocation on their side. Second, they are working on the tech side. They are enabling all the clients to go online and doing transaction. Third, there is a thought wherein they are going for factor-based funds also, where they are saying that let's eliminate, which is best of both worlds. You have a passive management and you have active management. You take a middle way. You take the best of both worlds, and you eliminate few factors. You keep few factors momentum, or let's say high dividend or whatever strategy you want to go at, and you go for those type of funds also. So they are getting some allocation on their side, and I see that both the strategies, the active management, which is right now in the existing phase, and the passive management as this new, which is the low cost as well as factor-based strategy, is going to coexist and do very well. So yes, that can be looked at also.
Okay. Mr. Navlakhi, what are your thoughts on the same subject?
So I think whenever any new fund house comes in and there is a new sort of launch, what is important to know is what is it, what sector or what category are they reaching out to? And if that particular category did not exist, then for sure we are happy to look at some of these newer offerings. But we find that if it's just a repetition and it's a similar sort of strategy as many other existing, then we'd rather wait to see track record before we jump in. But as Kshitiz mentioned, I think some of these newer strategies like the low cost index funds that Navi is coming out with, or the quant strategy, or now I can see even the maybe relatively older fund houses like Motilal Oswal saying, okay, here is a momentum strategy, here's a low volatility strategy on top of an index. So it's sort of filtering through the index and meeting a particular client's need. Those are things that, yes, you can sort of mix and match for the client. I think suitability is very important, that the new strategy is something that the client wants. And, for any new product, there will always be the first time adapters who will say, as soon as something new comes, I want to try it out. And there'll be others who will wait and watch and say, let me see how this performs before I jump in. And to each his own, I think.
Okay. Gentlemen, thank you so much. 3 interesting conversation bits, and I'm glad we got your views on all of those. Much appreciate you taking the time out. And thanks for being a part of the Mutual Fund Show.
Thank you so much.
Thank you, sir.
The pleasure was ours. And viewers, thanks for tuning into this leg of the Mutual Fund Show.